Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. Debits and credits. Debits and credits are the basic accounting terms that record the changes in the value of accounts. Debits increase the value of asset and expense accounts, and decrease the value of liability, equity, and revenue accounts. Credits do the opposite. Every transaction must have at least one debit and one credit entry, and the total amount of debits must equal the total amount of credits. This ensures that the accounting equation, assets equals liabilities plus equity, is always balanced. Debits and credits can be recorded in a journal or a ledger using a standard format. The left side of a journal entry is the debit side, and the right side is the credit side. In a ledger, each account has a separate page with two columns, the left column for debits and the right column for credits. The balance of an account is the difference between the total debits and the total credits. A positive balance indicates a debit balance, and a negative balance indicates a credit balance. Debits and credits are fundamental concepts in accounting that form the basis of the double-entry bookkeeping system. They are used to record transactions and maintain the balance of accounts. Understanding debits and credits is essential for accurately recording financial transactions and preparing financial statements. In this article, we will explore the meaning of debits and credits, their relationship to different types of accounts, and how they impact the accounting equation. Meaning of debits and credits. In accounting, debits and credits are used to record increases and decreases in accounts. While they may seem confusing at first, they are simply entries made on the left, debit, or right, credit, side of an account. Debits represent increases in assets and expenses or decreases in liabilities, equity, and revenues. When a debit entry is made, it typically increases the balance of an asset account or expense account, or decreases the balance of a liability account, equity account, or revenue account. Credits represent increases in liabilities, equity, and revenues, or decreases in assets and expenses. When a credit entry is made, it usually increases the balance of a liability account, equity account, or revenue account, or decreases the balance of an asset account or expense account. Relationship to account types. Different types of accounts have specific rules for debits and credits. Asset accounts. Assets include cash, accounts receivable, inventory, and property. Debits increase the balance of asset accounts, while credits decrease them. For example, when cash is received, it is debited to increase the cash account balance. Liability accounts. Liabilities encompass accounts payable, loans, and accrued expenses. Debits decrease the balance of liability accounts, while credits increase them. For instance, when a loan is repaid, the liability account is debited to decrease the balance. Equity accounts. Equity accounts represent the owner's or shareholder's interest in the business. Debits decrease equity accounts, while credits increase them. For example, when a company makes a profit, it is credited to increase the retained earnings account. Revenue accounts. Revenue accounts record income generated from business activities. Debits decrease revenue accounts, while credits increase them. For instance, when a product is sold, the revenue account is credited to increase the balance. Expense accounts. Expense accounts record costs incurred in operating the business. Debits increase expense accounts, while credits decrease them. For example, when supplies are purchased, the expense account is debited to reflect the cost incurred. Impact on the accounting equation. The accounting equation is the foundation of double-entry bookkeeping and represents the balance between a company's assets, liabilities, and equity. The equation states that assets equal liabilities plus equity. Debits and credits play a crucial role in maintaining the accounting equation's balance. Each transaction affects at least two accounts, with one account debited and another account credited. The total debits must equal the total credits for every transaction, ensuring that the accounting equation remains balanced. For example, if a company borrows $10,000 from a bank, the cash account is debited, increased by $10,000, and the liability account is credited, increased by $10,000. This transaction increases both assets, cash, and liabilities, maintaining the balance of the accounting equation. Conclusion. Debits and credits are fundamental concepts in accounting that enable accurate recording of financial transactions and maintaining the balance of accounts. Understanding the relationship between debits and credits and their impact on different types of accounts is crucial for maintaining accurate financial records and preparing financial statements. By applying the principles of debits and credits, accountants ensure the integrity and accuracy of financial information, supporting sound decision making and effective financial management.